All right, good morning, everybody. We'll go ahead and call to order the February meeting of the Longview Firefighters Relief and Retirement Fund. Members present, John Newstead, Maria Mills, Vicky Boggio, Angela Cohen, myself, James Parker. I believe Colby is on video, so he won't be voting today. We have a quorum, but he is paying attention, if nothing else. Only member absent is Logan Ledkins. Go ahead and open up for public comment. Will, Charles, you guys ready?
Yes, sir. Good morning, everyone.
Good morning.
Hey, Will.
This will be an investment report for the Longview Firemen's Pension Fund. All data in the report will be as of December 31st, unless noted. Pardon me. We'll start off with the market commentary, which is essentially the year in review. After gaining 26% in 2023, the S&P 500 index ended 24, up 25%, keeping the index firmly in bull market territory. The S&P 500 registered 57 closing highs in 2024, the fifth most for a given year since 1953. In the 6 years prior, with more than 50 record closes, S&P 500's median performance the following year was a decline of 3.5%. with gains only twice. As of the end of the year, the total return on the S&P was 25% for the trailing year, 9% per year for the last 3 years. That, of course, includes 2022 when the S&P was off 18.55%, and then 14.5 years per year for the last 5 years. And that includes not only 2022, but also the pandemic in the beginning of 2020. Small caps rallied 11.5% in 24 after having really rallied just in the second half of the year on favorable expected policy changes in Washington, increased onshoring and lower interest rates. And we've seen a continuation of that theme. Both small and large caps are up between 4 and 5% just in this very short period of time in 2025. After finishing 23 up 5.5%, the bond index finished 24 up just 1.25%. And of course, that follows 2022 when the bond index was off 13%, marking the worst year for bonds ever. November inflation data came in at 2.7, and bonds are about flat for the year, up maybe 1%. November inflation data came in at 2.7%, up from the inflation read at 2.4. And now we see the new inflation number is pushing 3%, and we've got a core number of 3.3, where if you take out food and energy, it actually goes up because food is actually declining as energy has. You've seen the price of oil dip down to about $71 a barrel, I think, today. The Fed lowered short-term interest rates from 5.25 to 4.25% in 24. And the yield on the 10-year Treasury rose, spooking the bond market. Now, most of the anxiety surrounding 10-year yields and indeed the bond market was centered around our fiscal irresponsibility as a country and what we've seen, particularly with the debt and deficit spending. And what we've seen as of late is the 10-year drifting lower as more austerity measures and efficiency measures are taken at the federal level. So I think the more we get our financial house in order, obviously the better the bond market will react, because the likelihood of recurring inflation will be lower. Supply side economics and producing more, deregulation, these are the things that are going to drive inflation lower, not so much. We just saw what the Fed's impact is. They lower interest rates 100 basis points and they go up. So the question is, market rates are what are real. That's what people are experiencing. That's what our real estate investment manager, who will be speaking at the end of my presentation, is agonizing over, is that 10-year yield, because so many loans are pegged to it. All right, and real GDP grew by 3.1% in the third quarter. GDP then drifted lower to 2.3%. So our Q4 GDP, so just as I said last quarter, we've got a setup for some potential volatility. I'm actually surprised the market hasn't been more volatile. I'm pleased, but it hasn't been quite as volatile as one might have expected with a 4% unemployment rate, rising inflation, fiscal irresponsibility, and the like. Current unemployment rate rose slightly from 4.1% to 4.2% in November and back down to 4.1%. Unemployment is currently at 4%, about 6.8 million members of the workforce that are unemployed. Clients fully invested, diversified, and rebalanced diligently. Indeed, this portfolio was completely rebalanced to a zero tolerance in the middle of December last year. It is our way of recycling gains and driving performance and also managing risk. Most importantly, we're managing risk. Every time we rebalance the portfolio, it limits the exposure to things that have outpaced other investments, and that manages the risk, thus preparing the portfolio for whatever is to come, whether it's good or not so good. So a little recap, the S&P was up just 2.4% for the quarter, up 25% for the trailing year. Bond index was down 3% for the quarter, up 1.25% for the trailing year. International stocks were down 8% for the quarter and up 4.35% for the trailing year. And also emerging and international stocks are up almost 9% in the first 6.5 weeks of the year, and emerging markets are up about 4.5–5%. So they're having a great year. And then oil closed the quarter at $71 a barrel, which is where it is at the moment. We have a balance sheet on page 1. This is as of December 31st. The total was $100,388,874.71. I have a new current balance as of yesterday. That would be $102,918,568.28. We had $62 million in equities, $32.3 million in bonds, $3.8 million in alternative funds, and $1.6 million in cash. The next page is a graphic representation of the prior page. Highly diversified portfolio. Page 3 is sort of a macro view by asset class. We have 44% of the portfolio invested in domestic equity, just 9% in international equity, 5% real estate, 5% emerging markets, 32% fixed income, 4% alts, and just 1% cash. The next page is the unit value schedule beginning at the beginning of 2011 on page 4. On to page 5, 2015, 16, 17, 18. I believe our firm was retained by the pension fund at the end of 2017, I believe. 2019, 2020, and you can see 2020 is where you see the pandemic quarter down 13.89%, eking out an 11.5% for the year with relatively low inflation at that point, 1.2%. The following year, the pension was up 11%, yet inflation was at 6.9%. Thus, the actuary really only can work with the 4% left over, the real rate of return, which, as I point out every time, the pension fund has a target rate of return of 7.5%, an inflation assumption of 3%. So the real rate of return target, net of fees, net of flows, and net of inflation, is 4.5%. Page 7, 2023, you can see that inflation was subsiding a bit, 13.79 for top line, 3.34 on the CPI, 10% for 23, and then for 24, the portfolio was up 10.37% net of all fees and flows. CPI was just under 3% for the year. And the real return for the year 2024 was 7.29%. So from 2011 to 2024, there have been $17.2 million worth of inflows, starting at a market value of $43 million, and the current market value is $102 million, nearly $103 million. So over that 14-year annualized growth rate, over those 14 years, the annualized growth rate is just under 5% net of fees and flows. The actual inflation experienced by the pension fund was 2.61%. So actually, even with the inflation of 20 and 21 and 22, we really didn't, it really didn't budge that long-term average too much. And the unit value for the real rate of growth over 14 years is 2.24%. As I mentioned, that target is 4.5%. When we ran this report at the end of 21, these numbers were 5.67% for the growth, 2.17 for inflation, and 3.5 for the real rate of return. So you can see how 22 really knocked our running lights out because of the exacerbation of the inflation on the negative rate of return. Of course, when we were hired in 2017, these numbers were 2.57, 1.72 in inflation, and that final number was below 1. So even though we're not on top of our preferred target, we've made a lot of progress over the last 6 years. Budging a number that's got 14 years in it takes a little doing. So executive summary on page 8. You see the Longview Firefighters total plan in a balanced peer group. The 5-year return of 5.83% lands the pension fund in the top third, just about the top third. The 3-year 2.3%, again, just about in the top third, and that 10.37% lands the pension fund firmly in the top third of the database. So for the past 5 years, things have been, everything was reallocated 5 or 6 years ago, and we've been monitoring the managers and rebalancing, and we've seen a great deal of improvement in the portfolio, particularly, and you can see amongst its ranking, among other similarly allocated portfolios. So looking at the individual managers, Loomis Sales Growth Fund, a large growth, 9th, 1st, and 24th. And as always, I really tend to focus more of our attention on that 3-year number. The 1 year tends to jump around quite a bit, particularly with active investment managers. So Loomis Sales, number 1 out of 629 large growth managers. Vanguard Equity Income, top quartile. They had some trouble back in 24. Actually 22 and 23 that they've worked through in 24. Clearbridge, 42nd. Fidelity Low Price, 36th. Hood River, 3rd. MFS, 83rd. They are our one fund on the watch list. But you can see they've already sort of come, they've coupled this 83 with a 46, so they're above average already for the trailing 1 year, but they are currently on the watch list. MFS International Equity Fund, 36. Fidelity Emerging Markets, 14th. Goldman Sachs was added last quarter, 32nd. BlackRock High Yield Bond, top quartile. And the senior loan, this was MetWest Floating Rate Fund that converted to an ETF at a much lower cost in 2024. And so it's now called the TCW Senior Loan ETF, yet it is still the exact same investment it was prior to. Page 9, the large cap, and now you see instead of alpha in rank, you see return in rank. So the Vanguard large cap, top third, mid cap, top third in the growth, mid cap core, 66, but again, you see that top quartile. A lot of the trouble that the interest or the index funds had really happened in 2022 because you had absolute full market beta, full market exposure in those funds. And index funds are the greatest place in the world to have money as long as the market's going straight up. When it falls precipitously, they take it on the chin because there's no one there with their hand on the tiller able to trade their way out of the trouble they gotten themselves into. So you kind of ride that ride with the indices. But 66th to 27th, Vanguard, you see that with the mid and the small, 72nd to 40th. The U.S. REIT, which replaced Nuveen, 17th, Guggenheim, 46th, PGIM, 34th, J.P. Morgan Global Opportunities Fund, 9th, Millennium, 1st, and 3rd, and then Blackstone Breads, and these are the investments that really don't have proper peer groups. I mean, you could put them in a peer group, but it wouldn't have any analytic heft. Blackstone Breads returns, Cohesive Capital, PIMCO Bravo Fund, and then the CC Student Housing. That's Campus Clarion Student Housing. Charles, do you have any comments on the alternatives performance?
Yes. I would look at Cohesive Capital. I believe we got a distribution in January for a little over $400,000.
Be sure to speak in the microphone.
Yes. So in January, we got a distribution from Campus Clarion for a little over $400,000. So that $600,000 value is going to change, but we have not received an updated statement. So that's why it looks the way it does. That's why we have the asterisks there for the preliminary value. So whenever we get that updated, we'll let everyone know.
With that size of distribution, the market value is bound to change.
Yes.
Your Honor? Not a problem. We're even. Page 10 of the report is the net return of the portfolio versus its custom benchmark. Of course, that custom benchmark changed quite a bit when we were hired 7 years ago. However, I think it's a fairer comparison, probably at the 7-year cut. So the total fund, that is a net return, net of all your fees, and the custom benchmark is gross. It has no fees associated with it. So going back the 7 years, 6.26 versus a 5.49, 5.83 versus a 5.69, 2.3 versus a 2.11, a 10.37 versus a 9.14. So for the past 7 years, even net of the fees, or gross of the fees, the portfolio has outperformed its custom benchmark year in and year out, which is just part of the exercise. I mean, if you have a group of investment managers, and by and large, those investment managers are beating their respective benchmarks, and the custom benchmark is constructed of those indices, it makes perfect sense that they should at least be within the fees that aren't being charged to those indices. And then the ranking on page 11, we saw a little bit of the ranking in the executive summary, but this is just a little bit broader. It goes back 10 years where we have the data. So 10 years, 57th, below average, 7 years, top quartile, 5 years, nearly top third, 3 nearly top third, and the first top third. So from a broad standpoint, the pension fund's doing very, very well. We're not recommending any changes amongst the current manager lineup that you have. The only real change that we're going to request would be the addition of another diversified hedge fund, because Millennium is no longer available to us, and we would like to round out that allocation. When we were first hired, the hedge funds were more than 10% of the total portfolio. So actually, when we were hired back in 2017, the portfolio was over-hedged. So for example, the portfolio didn't benefit like it should have in 2016, which was a huge year after the election, and 2017, which was another huge year. And we weren't able to pry loose of those illiquid investments. And over the years, over these past 7 years, we did pry loose of Balyasny, which was the other hedge fund that we had, but also the traditional portion of the portfolio has simply just outpaced those hedge funds. So the allocation to Millennium has shrunk as a percentage of the whole, and we'd like to shore that up a little bit. And I'll get into that just momentarily. Here are your expenses for the pension fund. This includes all of your investment manager expenses, $528,000 total. Moody custody charges, $25,674. And then the alternatives charges, investment management charges. Point out that the Kyle project of Rastegar has no management fee. The only compensation to Rastegar in that arrangement is the carried interest that is split between the pension fund as a limited partner and Rastegar as a general partner. And then our consulting fees, and you can see how those break out as well. So for a grand total of $751,334.47 to run a $100 million pension, and that expressed as basis points is 75 basis points. And I believe that when we first began, it was closer to 88 basis points. Also, always of interest, I should have mentioned this during the unit value schedule, but the pension obligation bond money that was deposited into the account midway through 22 and was invested over a course of 3 months in $16 million tranches, 16 million and change dollar tranches. That money, net of all fees, is up 26% from the point of investment. And if you annualize that, if you simply take 26 and divide it by the time, it's up 9.75% each and every year since that money was deposited. So I think that's well in excess of the debt service load on those municipal bond issues. Are there any questions on the report thus far? If not, if you would please go to tab 2. And actually, I tell you what, if you would if you'd go to the update, and you'll see on the update Millennium at, I believe, right around 2.5%. What we'd like to do is get that number up to closer to 5, the hedge funds. You're now a $100 million pension fund. What we're trying to do is, we do not want to tamp down the potential appreciation by over-hedging, as I described from 2016, 2017. But at the same time, we do want to have some insurance for what is known as tail risk. So the types of events that happened in 2022, the types of events that happened in 2020, 2015, 2011, 2008. I mean, you can just go back through time. Every 6 or 7 years, it seems like a bomb goes off in domestic equities. And what we're trying to do is simply get a little insulation in there, because when the bomb goes off in domestic equities, it's Millennium and funds like Magnitude that go up. And so that's what we're trying. I mean, your fixed income, and sometimes in times of great shock, the fixed income, the bonds, and the stock will move together. So what we're trying to do is have something, we've never been crazy about alts, but because the Millennium has shrunk to the point it has, and we can't get any more of it, the utility of having only 2.5%, it's not there. And we'd like to liquidate 2.5% of the fixed income, the bonds, from Guggenheim and PGIM. They each have currently about 9.5% of the portfolio. We'd like to drop them back to 8.5%, take that 2%, invest it into this new hedge fund, which only has a 1% management fee and decent liquidity, in order to get that. Oh, also, what I was going to mention is that I want to do this sooner than later, but keep in mind that as Cohesive Capital, as Breads, as the others roll off, those 4 little alts that you've got, as those roll off, the Cohesive Capital, PIMCO Bravo, and CNC Student Housing, that's another 1% that we can move back into bonds. Does that make sense?
Yes, sir.
So there's a little bit of rearranging the furniture, but nothing too drastic. If you'll go to tab 2, Charles, the Magnitude Capital introductory. Magnitude Capital, if you're familiar with the hedge fund world, and I wouldn't go assuming that everyone is, it's pretty boring. D.E. Shaw has been a very well-known hedge fund for a very long time and has done amazing work. They are one of the premier hedge funds and have been for decades. There was a lift out years ago, meaning a group of D.E. Shaw guys and gals were lifted out and started their own fund called Magnitude, I believe back in 2007. And they've done extraordinarily well since then. In fact, we read all the investment rags and what pensions are doing across the country. Some of the largest pension funds in the country have been hiring Magnitude over the last year. They are more than willing to take smaller amounts. It doesn't have to be a bunch of money, but at the same time, they've proven themselves to be very flexible and provide the types of returns that I've described, just offsetting when everything goes to heck. And that's really what we need them for. And of course, I'm not going to read every, but achieving your objective and their Magnitude Capital investment approach, flexibility. They were launched 21 years ago. It's run by 6 partners. Most of those fellows and gals came out of D.E. Shaw. They've got $8 billion under assets. 85% of the AUM in the firm comes from institutions. 68% North America, 30% international, inside the fund. You look at this page 4 is interesting, the quantity of returns, so that's net returns over its lifetime. That HFRI is the Hedge Fund Research Institute Fund of Funds average. So you can see how they've done against that average, 6.9% annually versus 3.9, 10-year trailing 6.6 versus 3.7. The volatility is lower, 4.1 versus 5. The 10-year trailing volatility is significantly lower, and that's what we're looking for. We're looking for lower volatility, a little better return, and good positive alpha production. Then you've got the investment team information on page 5 and 6. Page 7, more information about the firm. Page 1 of the next of their quarterly report, Charles.
Okay.
Quarterly report has all of their returns for going back to inception. So there's nothing opaque about this firm. They put it all right out there. And for example, you look at the beginning of 2020 when your portfolio was down 15% or 13.5%, 14%. This investment was down 4%. So that would have helped. It's that situation. That's the utility of owning these folks. And then also in 2022, they also had up 7.4% in 2022 when the stock market was off 18.55%. That is precisely the kind of what we're looking for out of them. And then there's some additional commentary that gets kind of technical. Page 3 goes through their allocation. I think this is kind of interesting. So these are the underlying strategies, the fund of funds that they are managing. They're a manager of managers. And when you look at this allocation versus Millennium, they're actually quite complementary, which is kind of a little bonus that I did not foresee happening. But Millennium is more concentrated. They're not nearly as diversified as Magnitude. Millennium will capture more of that upside. I mean, they will beat Magnitude on the upside. But for us, the utility of owning these hedge funds is not to make more money, it's to lose less money because the vast majority of the portfolio is not a hedge fund. We're literally hedging our domestic equity risk, just as they were intended to do. And then it goes through bottom contributors, top contributors. Interesting, momentum has been a huge part of the market for the last 2 years. It also goes through some shock periods on page 4 of what they did versus the fund of funds, and then the outperformance. So on a normal period, their outperformance from 02 to 07, 10%. The shock period, 1.8. Recovery, 11.2. Another normal period between 09 and 19, their outperformance is 35%. And then the current period, 20 to 24, up 29. Outperformance is 29%. Liquidity profile on page 6. This is as important as anything. In any given quarter, you can get 35% of your capital, 2 quarters 49, 3 quarters 59, and 1 year 73%. That's pretty rare in the hedge fund and alternatives world. That's pretty flexible. Alrighty, and I don't want to just bore y'all to tears. Let me jump to our report. Of course, I have all sorts of bias.
Leo, where's Millennium in this?
I'm sorry?
Where's Millennium in this?
I didn't bring all of Millennium's firm information.
Oh, so you didn't? Okay.
No, sir. All I have on Millennium is their returns inside the in a regular report format. Yes, sir.
Okay, so we don't have, so we didn't get the, okay. Thank you.
Yes, sir. And then on page 1 of our report, I'm sorry, it's not page 1, Charles. It's the return page. Well, go on, Charles. Go back to that first page. I can vamp on my feet. So this is the manager performance versus the Barclays hedge fund of funds index. And you can see the return at 6.92% over that period. The standard deviation, 4.16 under 5. And the excess return, next page, please. This is simply the trailing year returns. The black bar is the fund of funds index, and the blue bar is magnitude. Next page. These are calendar years, so instead of being geometric, these are arithmetic. Next page. You can also see where it sort of lands right smack dab in the middle of between So if you were to regress it like you would maybe an equity manager, you see that it's got a lot of mid-cap exposure in it, but that is simply a returns-based analysis. Next slide. Not returns-based analysis is for what we were just looking at is not a fantastic way to look. That's not the greatest lens to look through when looking at a hedge fund. This is October 22 through 24. The return, standard deviation, Sharpe ratio, excess return, tracking error. So that's the volatility of the excess return, and that positive 5% alpha. Upside, downside, you can see 215 numbers of periods up versus fund to funds index 170, down 52 versus nearly 100. Next page. And then the alpha production. It's enormous. Beta correlation. Yeah, you can keep going. Standard deviation, see it's below. Downside deviation is clearly below. And then the Sharpe ratio is clearly above. It really is a Goldilocks sort of scenario with this particular hedge fund. Next page. Next page. Next page. Next page. And the returns. Yes, sir. Thank you. These are the trailing returns versus the index. Next page. And then the ranking. So they are top decile across the board. And that fund-to-fund index is about where you'd expect an index, right in the middle of the peer group over a 10-year period. Are there any questions at this point? The next exercise is to actually take magnitude and model it into the portfolio to see how it would react, how the portfolio would react to the inclusion of magnitude. So if you would please turn to the asset allocation tab in your report. This is an annual exercise where we take the current asset allocation and test it over a trailing an entire market cycle. So this go around, we were going all the way back to the very rough year of 2015, had 2018, 2020, and 2022 baked into these numbers. They are net of investment management fees. However, they are not net of administrative fees or your consulting fees or the like. Our target is right at about 8%. You can see the retirement fund as it sits now is, and again, this is modeling. You know, this is a statistical exercise to get a handle on what we think the highest probability of the return and risk characteristics of the portfolio. This is not the gospel, but it is our attempt to understand what the likelihood is of the portfolio growing and at what rate of risk, and particularly given an inflation rate and given a distribution rate, what does that really look like in the long term? So the return expectation is a little over 8%, standard deviation is right at about 11%, which means that that normal range of outcomes in any given year would be, say, 19 or 20 to the upside and maybe -3, -4 to the downside. So what that means is that any calendar, I know we live and die by calendar year returns, but any calendar year that produces a return of, say, 20 to the upside, which would be fantastic, nearly 3 times your goal, or -4 to the downside, which is twice your goal negative, those are all normal. Anywhere in between is considered, because we can't get the 8% unless we're willing to accept the -4. And so that's sort of the tail of the tape. So the current plan, 8.29 with 11%, Sharpe ratio of 40. If we simply take 2% off of, a little over 2% off of each one of the bond funds, reallocate it to magnitude, you see it's not a great big earth-shattering change, but the return is a little bit higher and the risk is a little bit lower, which is precisely what we want out of any new investment. I mean, otherwise it's not worth the trouble. You can see the weights on page 3, and Guggenheim, you see 10.06 to 883, 10.06 to 883. And then magnitude goes, you see Millennium, 253, and magnitude goes from 0 to 247 to round out the hedge fund to 5%. I promise I'm getting close to being done. So here is, I think this is even more telling than the initial page of this. So you go, this is how time negates risk and really smooths volatile returns on page 5. So there's your best case scenario over a 1, 3, 5, 10-year, 20-year period. So the best case scenario for the pension fund would be that this fund grows at nearly 15% per year for the next 10 years. The worst possible scenario would be for this pension fund to only grow at 3.5% per year for the next 10 years. The most likely scenario is the expected. 8%, 7, 9, 7, 8. So it's somewhere in that 7.5% to 8% with a little bit of insulation in there, which is, I mean, that's by design. And then the range of returns for with magnitude, they're just a little bit higher. Oh, I'm sorry, I misspoke. The worst case scenario for the fund, I'm sorry, for the 10-year period would be a 1% annualized growth rate. And the expected risk, you can see the risk rate dropping. But yes, the worst case scenario for any 1 year is down 12%, down 13%, which is about where we found ourselves in 2022. That's why I like using historical data versus trying to project the future, because I have no idea what the future brings, but I can tell you that there have been some rough spots in this data set. When I first started doing this, we would go back to 2001 during the tech bubble because we wanted the asset allocation to fall on its face right out of the gate. And then as years went by, we used 2008 as we wanted that to be the first thing the portfolio did. So we'd under-promise and hopefully over-deliver. So page 6 is a range of returns including magnitude, and it's just a bit higher. And the risk is a little lower. So the Monte Carlo simulation on page 7, you see 30 years we're simulating for with 10,000 simulations. There's your initial wealth value of 100 million. We have an imputed inflation rate of 3%, which is what your actuary prescribes. And the fixed amount in outflows is about $2.5 million a year right now. That's not what it's always been, but ever since the city front-loaded their contributions in 2022, that's where we find ourselves. So I was trying to paint the worst picture I could and say, okay, you've got 3%. As the portfolio grows, inflation's going to ding it by 3%, and the outflows are going to ding it by $2.5 million a year. These are estimates, but we wanted to, you want to put a hurt on it and see how it performs. So page 8 is without magnitude. And so the dark green is the worst case scenario. This is just the same range of returns. So you're at 100 million, it makes the math pretty easy. You're at $100 million right now. The worst case scenario is that in 13 years or 12 years, you'd still be at $100 million. The best case scenario is that in 12 years, you'd be at $370 or so million. But the most likely outcome is not the dark blue, but sort of that middle blue. Not the baby blue, but the medium blue. I need to come up with a name for that color. And what we're looking for here is, can the portfolio continue to grow in spite of inflation and in spite of the outflows? And the answer is yes. And so we run this exercise every single year to not only test the constituents of the portfolio, like what is their risk and return, what do their return and risk characteristics still look like? And do we need to make any adjustments to still achieve the 8%? Well, no, the answer is no, not to the macro mix, but to shore up the hedge funds in case of a rainy day, which seem to come about every 6 years. We would indeed make that recommendation. But as far as manager changes, we're not making any. Are there any, I feel like I've gone through a lot today. Are there any questions? I'm happy to discuss any portion of this presentation.
As long as the percentage fits within our investment policy.
Yes, sir.
I do have some questions.
Sure.
So we're leaving Millennium unchanged, and we're adding magnitude. Both will be about the 2.5%, 2.6% mark, which will leave us about 5% total of the portfolio. And we're taking 1.23% from the total bonds of Guggenheim and Blackstone. which
I
carry a
believe it's
weighted.
PGIM.
PGIM? Oh, I'm
Yes, sir,
sorry,
and
not
Guggenheim.
Blackstone. PGIM, I'm sorry, yep.
Yes, sir.
Which is a weighted total of 10% each on that. Right.
About 10.6, yes, sir.
Yeah, so 20% total of the portfolio, and you're reducing about 5%, so we're at 15%
Correct.
on that. And I talked to you out on a sidebar about it, but my concern again is the timing of the bonds. So yields fall, bond prices rise. We're coming off of a worst performing bond deal, and so it's like we're taking it from, we're selling low and moving it into something else. And
It
so
is-
that's
yes,
my
sir.
concern. And what's your thoughts on that?
Well, for us, this is more about insurance than anything else. And I agree with you completely. We would have thought that the bond market would have rolled over or improved or found its footing, however you like to put it, sometime last year. But it just never did because the specter of inflation is still looming, and that has not changed. So we feel like the inflation could be very persistent moving forward, particularly given some of the policies that are being sort of batted about. And we just don't see bonds producing yet. Otherwise, we would have already changed some of the, well, for example, we would have reconstituted your fixed income composite by eliminating some of the floating rate, which initially we thought, well, maybe the floating rate will be the place we'll go for the hedge funds, but the floating rate's still yielding 9%. And there's still just a slight chance that interest rates could continue to go up. And so we don't want to try to predict the future when it comes to bonds, but we know we're not sure of what the future of bonds holds, but we're certain that the volatility in equity markets needs, in a $100 million pension fund, needs just a little bit of tamping down. Not much, but just a little bit.
Okay, so you answered the question. My next question was going to be why not go after the floating rates?
That's precisely
On
why.
that.
I would have preferred to do it, but you haven't said we're nowhere near our terminal rate. And the likelihood of the Fed continuing to lower rates this year is getting smaller and smaller and smaller.
Well, the issue, I mean, as long as the government keeps adding, I think it's like $200 billion worth of debt, and then bonds, and then you have the Fed rolling off about $20 billion in bonds per month. So it's really more about them unlevering their balance sheet. You're going to continue to have a supply side like you talked about. The concern, so what happens with, let's say it does change though, what do you see as the plan for the floating rates?
Exactly.
And where to move that to?
That's a great question. We would take the floating rate and most likely redirect it to a private credit or potentially a high yield bond fund.
Okay.
And those are actually that's something, go ahead, John.
No, that's,
No, it's just something that you triggered. I meant to mention this earlier, but we would also like the permission of the board because we want to kind of get ahead of this fixed income market a little bit. We'd like the board to entertain a presentation by a private credit manager in order to potentially entertain that as an option when we do get a little closer to the terminal rate and we feel like the bond market has really found its footing.
I think that'd be good. We'd be increasing our alt exposure with that as
Yes,
well.
sir.
In addition to this addition we're already making too.
Exactly.
On the, also on the, just on the 10-year treasury, like we've double topped. And so it looks like it's firm, like it's holding in that end. We don't know where it's going to go, but it seems like it's been double topped on the 10-year treasury.
Fingers
Yeah.
crossed.
Yeah.
I'm not much of a technician.
Okay. Well, me neither, but that's, so we have that. And then the other side of it, you mentioned, what was the actuary rate on the investment return they were on?
7.5.
7.5, and that's not before inflation, right?
Correct. That is before inflation. Net of
before
inflation, it's
inflation is what I
4.5.
meant,
Yes, sir.
4.5 net of inflation?
Correct. There's a 3% inflation assumption.
Okay. And then looking at the performance of 24 versus 23, we underperformed in 24 compared to our performance in 23, based on even the S&P having similar returns for those 2 years. What would you credit that to?
Pardon me, John. Let me get back to my unit value
That's fine.
schedule.
So we did a nominal return of 13.79, and then we had a 10.37 in 24.
Well, I do know that the stock market was higher in 2023, about 2 points higher, but that wouldn't account for 3.5% delta. I wouldn't want to speak out of turn, but I'm happy to get you a full explanation of that.
All right,
But that could easily be chalked up to some manager underperformance. I know that there hasn't been asset allocation changes in those last 2 years of any significance. So I would imagine that it's going to be the fixed income because the equities performed similarly in both those situations. But 35% of the portfolio is fixed income and alts and the cohesive capital and the breads. And so those clearly contributed to that underperformance that relative underperformance in 2024 because the equities had a similar experience in 24 as they did in 23.
I believe we sold out of a high growth tech type fund too, maybe, if I remember correctly, on that, because we had a terrible underperformance in 2022 with that fund due to the tech sell-off.
I think Loomis Sales, our large cap growth fund's been there for some time.
I believe it's small growth.
Oh, small growth. That's the one you're thinking of. Yes, Hood River was hired to replace the small growth manager, and that was a source of underperformance.
On that, okay.
Yes, sir.
Yeah, if we just look at that on there overall, though, it's great. I was just curious because they were similar in performance on the S&P for that. And then the other thing too, on your report for the total plan and on for your that shows the date, market value, contribution, withdrawal, nominal return. That page.
Yes, sir. What page?
So is there a reason why we use a 14-year?
That's all the data that was available to us when we were hired.
Okay, so could we do it where we show like lifetime and then 1 year, 5 year, 10-year? Is that feasible?
Lifetime would be a
Lifetime,
lot of work.
Well, lifetime would be,
For-
I'm talking about, when I say lifetime, I'm talking about 14 based on the data that we have.
Oh, the inception date?
Correct, inception date.
You want that
That'd be
on the
better.
trailing page?
That would be a better, I guess.
Okay.
Because and then also if we could put on the report, somewhere there's a mark that y'all could show where you end up taking over the portfolio.
Sure.
And indicating, because every time we do this meeting, we do an adjustment for that to explain it, which I think is important to know for the public, but if
Sure.
we could just have that on the report every
Sure.
time, so we don't.
Of
we can
course.
quickly
Charles, did you make a
reference
note of that?
Yeah, I believe our first quarter was first quarter 2018.
Yes, sir.
Yep.
We'll put an asterisk by our first quarter.
Yeah, put something there to indicate
And we can
that.
put the trailing 5, 3, and 1. So you'll have them on page 9 at the top of the executive summary, and you'll also have them at the bottom of the unit value schedule.
Okay, awesome.
And then you'll have them on the regular trailing returns on page 10.
Just to add inception, correct?
Well, yeah, since inception, just
Okay.
if we're gonna do, because, I mean, 14 years is a hard way to look at it in a
It
sense,
is.
but if it makes sense if it's coming from an inception date and then looking at it in those other increments that we're using, that a normal fund provides the
Yes, sir.
information on it.
Sure, yeah, we used the 14-year because whenever we first started, that's all the data that we could get that was reliable. We could probably get more data, but we had to reconcile everything.
No, that's fine. I mean,
Sure.
there's plenty of history there for us to base off, so
Okay.
appreciate it. Thank you, Will.
Thank you, John.
Any other questions?
Mr. Chairman, that would conclude my presentation for the day. The only thing left would be a short presentation from Investment Manager Ari Rastegar, who is on a Zoom call, or Zoom conference, video conference, and he will give us an update on the Kyle project that I had mentioned during the fee analysis. Thank you, Ari.
Morning,
Hey,
Art.
thanks for having me. Hello, everybody.
Hey, Ari.
Well, I took notes during your presentation myself, literally. So, can everybody hear me okay?
Yes. Yeah.
So a few things. One, with respect to the project, I think I want to knock on the wood that this that this computer is resting on, because Kyle has just been an absolute anomaly with respect to other markets. Looking at real estate at from a bird's eye view, there's been just a lot of pain in the market overall. I mean, rates have been a tremendous problem, as we know. Kind of a base case understanding or a rudimentary understanding of real estate speaks to, as rates begin to rise, cap rates begin to rise, and values begin to drop as a general rule. I think the 10-year has been a very, very interesting exercise because if rates gone down, the 10-year um, has been difficult to say the absolute least. On the Kyle loan in particular, for the first phase 1A, which is about 338 lots. We've been working through all the horizontal construction work to activate the elementary school, which I can very joyfully report to everybody will open in the fall of 2025, which seems almost incomprehensible. Being, just a couple years ago, we were at the groundbreaking ceremony, had hundreds of friends and family and clients from all over the country there. But the school is opening. We continue to construct Gristmill Road, which is the main thoroughfare between the two lots that we aggregated. And in fact, we expect for the first tranche of lot sales, which is the first part of our business plan, to effectuate and close at the beginning of Q2. We put 338 lots under contract with two national builders. And those will close then, which would pay off the large interim financing loan with Trez Capital, which is about $32 million plus or minus. The loan was actually set against prime, which is, as you all know, is closely run with how the federal fund rate works, and has a floating rate loan, which has actually worked to our benefit during this time. The cost of capital is a little bit higher than I initially underwrote a couple years ago when we were looking at this through a spreadsheet. But the market continues to increase in demand and price across the board, so much so that we are in final negotiations with D.R. Horton to buy another 500 acres in Kyle, which I believe, with the construction of the remaining lots, the apartments, et cetera, would make us by far the largest owner within the city, which has been very advantageous for our clients, which is great. So really, this site catalyzed, for lack of a better word, the growth across the region. So Austin, as a whole, on average, has struggled. The supply around apartments has been a challenge. The bigger stuff around, the industrial, the master plan communities, data center, prospective data center sites have done incredibly well. So Kyle has really been a breath of fresh air, and we continue to optimize that portfolio and find ways to really keep some of this product a little bit longer term. So once we do sell enough lots to begin to pay off this initial loan, we plan by the end of Q3 going into Q4 of this year, we believe we can start to look for potential liquidity events for our investors within this product. Clearly, some of the build for rent housing and some of the apartment construction and commercial construction will be a little bit longer by design, but we're going to have a very serious dialogue about whether or not we want to continue to sell more lots to de-risk and return a little bit of our initial capital. Do we still feel the risk profile is as such that we can be a little bit more longer term and get some recurring cash flows from the BTR and for the apartment construction on the site? The net is it's just been great, and which has been nice considering the pain that we've seen in other parts of the market. And we're going to continue to invest in Kyle, continue to make our presence known in Kyle, and do something really, really special. So we're pleasantly surprised with some of the other more global kind of doom and gloom news that you see across real estate in general. We're kind of done waiting for rates to come down. Quite frankly, I think, sitting and waiting for the rates to come down, restructuring some previous loans, is just a game that you can't control as much. And I think, we've spent a little too much time obsessing over it. And I want to shift our kind of energetic asset allocation to what we feel like we do best, which is creating alpha through entitlements and not focusing so much on the beta aspects of our business. And that's where we found the most success. And where we found the success in our big project in Dallas, which is coming online Construction starting over the next 4 to 5 months. Construction starting on a large multifamily project that's frontage road on South Congress. So this is a very profound year for Rastegar as a firm, for our clients, all our consultants and staff, that we really continue to go vertical on land that we've held for many, many years, gone through the entitlement process, gone through the permitting process, created the value through more of the operational prowess, such as the entitlements, et cetera. And it's continued to do what we've done. We've built the machine. We have phenomenal groups that we're working with down there in Kyle, and it's to continue to rinse and repeat and continue to refine our process around lot sales, around the horizontal development, move into more in the vertical development side over the next 2 quarters, and continue to reap the benefits not only of the city's growth, but of the work that we're doing every day with boots on the ground.
Just a quick question. I know that obviously this is a long-running project for you,
Yeah.
a lot of moving parts. Do we have
Yes,
any
sir.
kind of time frame on a reevaluation for our records?
Sure, it's a great question. So what we do as a firm, what we've done for the past decade, is these types of project we keep at par. And again, the auditors, come and look at this stuff, and I can set up a time for y'all to speak with our third-party admin to get more of an assessment for your records. But us internally, if we start valuing these properties, what happens is you could create a taxable event through these particular vehicles without having the cash to cover the taxes. And with some other family offices, along with your pension and others that don't have the same tax treatment, it could be quite negative assessment to really look at what the values are going to be. So I can speak with our auditors, speak with our admin, and see if we could come up with some sort of soft assessment or get a broker's value opinion or something that could help with your records. But getting an actual assessment done that would give the quote market value today for the entire fund for tax purposes is not something that we're going to do in the foreseeable future.
I understand that, sir. It's just that soft assessment for us would be
Yeah,
appreciated. So
yeah. Let me think about
That's
let me think about how to do that. And I'll work with Will and work with Charles and work with our admin to put something together. What I am very confident to tell you is that we have this one's going really good. So I'm pretty proud of that for all of us.
That's what I was going to
Sounds
ask
good.
you,
Thanks, sir.
Ari, is that we're not going to hold you to this. I'm not going to pin you down. But what does your gut tell you? You've done this for a long time.
I have. And look, I think that the only reason I give a little bit of of pause, and all of you all know me, I don't have a problem talking, unfortunately, good, bad, or indifferent. The only thing that gives me, so when I look at our pro forma before this call, and I looked at what our projected returns are and the multiples on equity that we're projecting, I think we're very much in line with pro forma in terms of value creation. The one X factor, as we all know, is that our borrowing cost was substantially higher than we initially underwrote. So I think we're about 375 basis points higher than we had initially thought where the rates were when we really carved in these numbers. We were more in, closer to the zero interest rate environment. So, with that said, I think we're absolutely trending towards pro forma. We're absolutely trending towards a multiple on equity. And if a couple things go well our way, I think we could actually beat the pro forma, which would be trending towards above a 20 net IRR with respect to the trajectory that we're on at the moment.
Thank you.
Thank you, sir.
Mr. Rastegar, thank you for your time.
I have
Thank
a
you
few
very
questions,
much.
actually.
Yes,
I got
sir.
to see
John,
Paul in person.
one second, Ari. We've got another question
I'm
for
sorry. All right. So last time you spoke, you were talking about there's going to be a return of capital at first quarter, second quarter of this, I think it was this year, right? And it was last year. And what was the delay for that? What's the reason for that?
Sure. Yeah, sure. So basically there's no delay per se. The negotiation for the lot sales, which is the phase 1A and phase 1A 1AB composes about 338 initial lots. So what we had thought initially was that we would sell what's called paper lots, which were lots that weren't fully built out to pass along to the builders, which is a smaller dollar amount, and less infrastructure cost for the firm itself. So in looking at the upward trajectory of the market, we saw that to capture better risk-adjusted returns, we would go in and build more of the horizontal infrastructure, more of the below-grade construction. So in procuring the loan with Tres Capital, which is a Canadian, private bank out of Canada, we went and did more of the work and increased the timeline, albeit the cost. But when you look at the spread on alpha longer term, to be able to utilize that capital to invest more into the project, to recycle into the further development, the longer term net return appears to be significantly outsized. So is a better use of capital to use some of the financing mechanisms to go towards what we call finished lots versus paper lots, and miss out, so to speak, on a shorter term liquidity return of capital, but we would have been missing out on a much larger gain.
Thank you. That answered the question on that. So and you're talking about also, to me, it's a return of capital, just different way, right? You're just reinvesting in the business. The other part of it, when you look at doing the liquidity event and into Q3, Q4 with the return of capital, I mean, is this you have different options? You can reinvest, you can debt pay off, you can do a distribution. Are we going to maintain the same amount of ownership that we have from what you see, or will our ownership stake be reduced in that event? How would that work?
So that's an excellent question. And with a lot of this size, it'd be a very poignant answer if this was one property, so to speak, with respect to if this was 1899 McKinney. It's a single lot. Let's say you build a building of condos. We're building apartments, but you build condos, you sell a few. There's a profit margin, there's a return of capital, and that part of the asset is sold, gone, liquidated. Well, in this particular project, you have over 1,000 single family lots that can be either sold as paper lots on one phase, can be sold as finished lots, could be kept longer term for additional equity to build for rent houses. Some of the homes could be built for sale in partnership with a builder, in addition to the commercial site that will be built to cash flow, in addition to the 1,400 apartments that can be built and cash flow longer term. I say all that to you as this project has so much inherent diversity in it and so many different levers that can be pulled from a liquidity and from a cash flow standpoint, to where if we sold lots at these first 338 lots and they are completely sold and we didn't have the debt instrument, well, that would be return of capital with a certain amount of property, and that's kind of gone, so to speak. But the capital that we could generate from building the apartments, getting a stepped up value from zoning, and returning, some of the initial equity, there are parts within that structure that we would keep our ownership percentage intact with respect to that phase. But depending on how the liquidity event is structured and what we are selling and where the cash flows are being generated from, will determine whether or not we're actually selling our interest and liquidating a percentage point, or we are reinvesting or getting revenues that have been created through construction. So I know it's a little bit of a convoluted answer, but there's still some things in the future that we're trying to figure out with respect to actually liquidating, selling, and de-risking, or do we still believe that there is very, very strong risk-adjusted returns that would enable us to continue recycling? And in that event, the principal percentage ownership is not changed. In fact, the percentage and the value of the fund value amount is actually increasing incrementally. And so what I'm going to do is, with respect to the previous question, I'm going to work with our admins and work with our auditors to see if we can come up with a current valuation for you, with either a broker's value opinion, a series of third-party opinions, because as I said, from an audit standpoint, I don't want to create a taxable event without having the capital. So let me work through those things. I'll get them to you. And as the market dictates the path for the highest level of risk-adjusted returns with respect to this liquidation, I can come back here in a few months and we can talk through what that looks like. But when you have this type of versatility in a project of this scope and magnitude, and quite frankly, us as a firm continuing to buy another 500 acres within very close proximity, and another 100 acres on another development site would put our total holdings to close to 1,000 acres within this market, which is a testament to our belief in the long-term value creation and the downside protection with respect to where the pricing dislocations are in Austin. So I know that's a little bit longer answer than you bargained for, but I will. But this is something that is continuing to iterate. Our goal right now is to close on this first 338 lots that are under contract with earnest money up to pay off this first phase 1A construction loan. And once we make that payment, pay that off together, we'll reassess the entire project and build some more forward-looking models with which parts we want to keep to rent, which parts we want to keep for sale, if we want to sell some of the multifamily lots. And once we create that updated model based upon the success to this point, I'm happy to sit with the board and walk through what that strategy is and kind of reassess what we think the timeline is, not only for return of capital, which is the most important thing for me as we're talking, is in a perfect world, if we get to a point where we can sell enough lots that are finished or paper and return a vast majority of our initial capital investment, but still retain a large percentage in the overall project. I believe that particular model, if we can pull it off, is the most advantageous because it allows us to really capitalize on the uptick of Kyle. One thing I have a very, very strong level of conviction about is 10 years from now, when we look at this micro economy that has consistently been in the top 1 and 2 fastest growing markets in the United States of America, really since 2010, it's been on the top 10 list. We want to keep this stuff as long as we can because it's going to be one of those things where we look back and say, shucks, we should have kept more build for rent houses. We could have kept apartments and been a little penny smart, pound foolish, and not really capitalized on the true value of an illiquid investment. Because I think something that we look at and we speak about with the advisors we work with in the various pension plans or family offices or institutions is, what is the net benefit I'm getting as a pensioner, as an investor, from an illiquid asset? So if you're trading liquidity for returns, which effectively is what you're saying in a vacuum, is, well, if I can't liquidate this thing right now, we should be able to make outsized returns, whatever that number is. 500 basis above the S&P, 500 basis points above the S&P 500, as an example, is one of our institutional clients. They look at for if there's not at least that much of a spread, they don't want to take the illiquidity risk. So that's the part that I'm kind of weighing right now is, where can we truly capitalize on the illiquidity of this asset and really create long-term value and not be penny smart, pound foolish.
Thank you. And I would be interested whenever we get to that point to know that return of capital, what percentage of that is our initial investment and how much does it reduce our ownership compared to capital gains? Because we're not a taxable entity, so I know we have a little different of stack on how we want the returns to be. So.
Well, we'll work with your advisory team, and as we get closer to that, these are based on some of the other loan restructurings and things that I deal with in my day job. These are very high quality problems, and I'm happy to report that.
Thank you, Ari.
Sure. Will, was there anybody else you had?
No, sir.
That
would conclude our presentation.
Thank you, everybody.
Thank
Thank
you.
you.
Sorry.
All righty. I guess we're going to move to items for action. Review and motion regarding recommended trades for fourth quarter pension performance presentation.
Move to approve.
Second.
John moved to approve. Maria seconded. All in favor?
Any discussion?
Oh, I apologize. Thank you. Any discussion? Like everything was pretty solid. As long as we're staying within our range and trying to protect ourselves in every path, I'm good with it. But.
Thank you very much.
Wait,
Yeah.
now you vote.
Move to-
Yes, ma'am. Anybody move to, you move to approve, you move to second?
All
All in favor?
Aye.
Motion passes. All right, item action B, review and motion regarding reconciliation for the month of January 25th, 2025, January 2025 for Moody checking account, Moody disbursement, and MSSB Omnibus.
I move to approve.
And the big check to Nationwide PM?
It's a drop from previous month approval,
Okay.
retiring.
Second.
Any discussion? All in favor?
Aye.
Aye.
All right, review and motion regarding internal financial statements for January 2025.
I move to approve. Second.
Any discussion? All in favor of approving?
Aye.
Review and motion regarding minutes for January 2025.
Motion to approve. Second.
Any discussion? All in favor of approving minutes?
Aye.
Action item E, review and motion regarding refund of contributions to Carla Rains due to separation. For those who don't know, she was one of our newer folks, had some issues with some testing. Sounds like she was a solid employee, and I think we'd be happy to have her back. But it wasn't anything of a negative action, so.
I move to approve. Second.
Any discussion? All in favor of approving?
Aye.
All right, items of discussion, upcoming retirements. I think we have 2 in the next couple of months. March. We've been told March. I don't know if that's been passed along to you. A captain and a chief.
I'm aware of one.
Okay.
2 months, yes, sir.
Yes, ma'am. That's all I know of. I don't know if anybody else. But, discussion of children's benefits. This was something we talked about last month and requested. I believe Pam sent a certified letter trying to get information. So we're not going to say her name, obviously, since it's a recorded line, but she has been verified.
That's good. And that's the form in front.
I believe so,
Yeah,
yes, ma'am.
for
Okay.
verification of.
Then I move to approve her benefits.
Second.
I guess we're not voting, we're just discussing.
Oh,
Yes,
that's
ma'am.
discussion.
Okay.
I was just letting y'all know that Pam did follow up. She did send
That's good news.
certified notification stuff. Finally got the verification enrollment. I guess she said that it's been a consistent issue from that school getting that verification. So do we on items for discussion C, the re-election of citizen board member for a 2-year term?
I think we vote on it
Maria
next
Mills.
time.
We vote on it next time.
So if y'all want to bring somebody up here, we can duke it out.
Are you still interested? You're still interested in continuing
I'm still in it to
service?
win it.
All right. Sounds good. D, upcoming conferences, the Techspurs Annual Conference, March 30th through April 2nd. That looks like it's down in Austin. And then the Techspurs Summer Forum, August 3rd through 5th in El Paso. And then the Telfra Annual Conference in Abilene, October 5th through 8th. I know I won't be attending the first one, but I'll be going to El Paso.
I won't go to the first one either.
I'm not going.
All right.
Vicky, you
Vicky,
going?
you
I'm going. Okay.
Angela's thing.
Next regular scheduled board meeting is March 18th at 8:30. I will not be at that one. I don't know if anybody else has any issues. We need to reschedule that one.
March 18th.
I probably
I'll
won't
be
be
here.
either.
I will not be here.
My wife's birthday.
We'll check with Colby and Logan, see if we need to reschedule.
I
if
can
we're not
be,
gonna have.
I can be here. so.
Okay. I know I for sure won't be, so if we won't have a quorum, we'll see if we can reschedule with those folks if there's an issue with anybody. All right. Anything else from anybody that would like to pass along or discuss?
No, great job, JR.
Yes.
Good job.
Or if y'all are okay with it, we'll go ahead and discuss adjourning.
Motion to adjourn.
Second.
All in favor?
Aye.
Aye.
Well, Charles, thank you very much for coming out.
Thank you.